you're choosing a financial planner, there are 5 basic questions to ask. First of all, you want to know whatever their qualifications are. How long have they been in practice? What has their experience been? Do they have advanced degrees? But your portfolio is way too important to be left just to anyone. You want to find the very best of the best. Have they published any articles? Are they published authors? Have they been recognized nationally by independent groups for their expertise or for their contributions to the field? Number 2, you want to take a look at the services offered. Are they fairly narrow, meaning that they're focusing just on insurance products or just on mutual funds? Or, alternatively, are they focused on comprehensive wealth management? Are they bringing everything together? Not just mutual funds, not just insurance products, but also active portfolio management, risk management, tax and estate planning, asset protection, and services for high net worth investors. You also want to figure out how are they paid. In the field, there are generally 2 methods of how they're compensated. Either A, by commission, or B, fee only. I'm going to tell you a little bit how the typical structure is, and that's commission-based. That's how maybe 90 to 95% of the field is compensated. It typically works like this. They're paid, generally a commission, 5 to 7% up front with a small trailer fee. Now, the problem with that business model is that the financial advisor receives a big chunk up front, and there's no incentive to manage and actively protect that portfolio once that sale, once that commission is made. So that's one of the reasons we feel that once that commission is made, that the mutual funds, the stocks, are not changed out for 2 years, 5 years, or 10 years after, even though market conditions have changed. Those mutual funds have been the best, but the market's evolved and they're doing worse in the market, costing you big points from an opportunity cost perspective. It's also the reason we feel that changes aren't made to protect the portfolio when the market starts to go ahead and crash. You also want to check and make sure if the financial advisor receives transaction fees whenever a trade is made. They may be fine because they're receiving transaction fees, but you want to make sure that they're not doing it just in order to generate fees for the financial advisor. You want to make sure these trades are being made in your best interest. Also, the other problem that we're concerned with on the commission side is that they're often paid more money by representing products that are put out by their company. Number 2, they're also often paid more money by putting you in one investment rather than another, and there's no required disclosure. We have concerns with that business model. The other alternative is one that is fee-based. There's no commissions paid. Number 2, there's no transaction fees received whenever a trade is made. It works like this. The financial advisor, instead of getting commissions, gets paid a small annual percentage of the portfolio. That way, if you make more money, the financial advisor makes more money. If you make less, the financial advisor makes less. That's a win-win alignment. That way, the financial advisor has a direct stake in the performance of your portfolios, and one of the reasons that fee-based financial planning and money management services are exploding in popularity.